After studying this module, we shall be able to understand the concept of quoting bank, calling bank, price maker and price taker. Understand bid and offer rates in the money market. Compute bid, offer spread and its determinants. The spot quotation always gives one rate, that is 52.75 International Rupee for 1 US dollar. But in contrary to this, in any marketplace, buyers and sellers give their own buying and selling rate. Hence, at a given point of time, there are two rates available. These two rates are known as bid and ask rates. Bid-ask rates are given by forex dealers who are willing to buy and sell forex at these rates. It is to be noted that in the traditional market, the buyers and sellers are normally separate entities. For example, buyers and sellers of commodity would be different. A buyer is a user of the commodity, while seller is the producer of the commodity. However, in forex market, buyers and sellers can be individual entities, that is exporters or importers, as well as a single entity buying and selling a currency simultaneously. The difference between these two rates is known as bid-ask spread. Different aspects of bid and ask rates are discussed in the session, that is what is quoting bank, calling bank, price maker and price taker. The concept of bid-ask rates has been explained with suitable example. This chapter makes familiar the reader with concept of bid-offer rates in money market and the foreign exchange market. This is being followed by the concept of reference rate and how bid-offer rates are constructed. At the end of this module, we can analyze the possible determinants of the spread. The concept of quoting bank, calling bank, price maker and price taker. Quoting bank and the calling bank. It is customary in interbank markets for banks to quote two-way prices. There are two parties to the quotation, the quoting bank and the calling bank. The quoting bank is the bank that quotes the price. The calling bank is the bank that calls to ask the quoting bank for a price. Having been quoted the price, the calling bank accepts it, in which case a deal is done, or rejects it, in which case no transaction occurs. Price maker and the price taker. When banks quote interest rates and exchange rates to customers, it is often obvious whether the customer wants to borrow, lend, buy or sell. Consequently, it is sufficient for the bank to quote a one-way price. However, on occasions, customers require two-way prices. A more general description is to refer to the quoting bank as the price maker and the other party as the price taker. Whenever two-way prices are quoted, the first rate quote is known as the bid rate and the second rate quote is known as the offer rate. The bid offer or the ask rates. Suppose Central Bank of India, a dealer in forex, is quoting bid ask in terms of euro, where Indian National Rupee is equal to 77.62 euros to 77.6048 for spot transaction at 11:15 am on 29th August 20,000. Spot rate by SBI in terms of Indian National Rupee per euro, the bid rate is 77.6025 and the ask rate is 77.6048. In this quotation, euro is the base currency while Indian national rupee is variable term or quote currency. Bid ask price is always expressed in terms of base currency. The bid rate indicates that CBI is willing to buy euro from the counterparty and pay Indian national rupee equivalent to 77.6025. The ask rate indicates that CBI is willing to sell or give 1 euro to the counterparty and accept or receive Indian national rupee equivalent to 77.6048. In other words, for every euro CBI buys and sells, it makes a profit of INR 0.0013. Ask offer rate is always lesser than the bid rate. While buying a currency, the traders pay a higher amount compared to selling the same amount of the currency. The bid-ask spread is what the bank or the foreign exchange dealer profits. The quotations are for the spot rates, while publishing quotations in any screen or over phone, bank quotes the base currency first. In GBP over USD, the GBP is the base currency and the US dollar is the variable quote term currency. Similarly, in GBP AUD, the GBP is the base currency while the Australian dollar is the variable quote term currency. The bid and ask rates are from the bank's perspective. In the first row, given in table 12.2, at a bid price of 1.62536, the bank would buy 1 unit of the base currency and sell 1.62536 units of variable quote term currency. In other words, the bank will buy 1 British pound and pays 1.62536 of US dollar. At an ask price of 1.62576, the bank is willing to offer 1 British pound and receive 1.62576 of US dollar. If a company wants to sell 1 million British pound, the bank should buy 1 million British pound and receive the US dollar. Then the company would pay 1 million British pound to the bank and receive 1,62,536 US dollar. If the company wants to buy 1 million British pound, the bank to sell the British pound, the company would pay 1,62,576 US dollar. Bid ask spread determines the profit for the bank. It is very important to understand at this point is bid price is always lesser than the ask price. Now if a company wants to buy or sell US dollar as the base currency, then which rate it would be able to do so? The bid ask rate of 1.62536 for 1,62,576 will not be directly applicable. The rate needs to be converted so that the US dollar becomes the base currency and the British pound became the variable quote term currency. If we merely reverse the rates, that is 1 upon 1.62536 and 1 upon 1.62576, we get a bid ask spread of 0.61524 minus 0.61509. Bid and offer rates in the money market. In the money market, the bid rate is the rate at which the quoting bank is willing to borrow. The offer rate is the rate at which the quoting bank is willing to lend. A bank quotes 3 months dollar at 4% to 4.25% per annum. The bid rate is 4% per annum and the offer rate is 4.25% per annum. In full, the quoting bank is saying that it is willing to borrow dollars for 3 months at a rate of 4% per annum and to lend dollars for 3 months at a rate of 4.25% per annum. The price taker performs the opposite side of the transaction to the quoting bank. If the price maker borrows, then the price taker lends, and if the price maker lends, then the price taker borrows. If the price taker wishes to borrow dollars from the quoting bank, it must borrow at the offer rate, that is the lending rate, of 4.25% per annum. If the price taker wishes to lend dollars to the quoting bank, it must lend them at the bid rate, that is the borrowing rate of 4% per annum. An alternative definition of the bid rate would be the rate at which the price taker can lend. Similarly, an alternative definition of the offer rate would be the rate at which the price taker can borrow. Now we can discuss a few examples. The first example is bid and offer rates in the money market for 3-month dollars. The bid rate, offer rate, and the quote is 4% per annum to 4.25% per annum, and there are certain price makers, borrowers, lenders which lend and borrow. Bid and offer rates in the foreign exchange market. In the foreign exchange market, the bid rate is the rate at which the quoting bank is willing to buy the commodity currency. The offer rate is the rate at which the quoting bank is willing to sell the commodity currency. A bank quotes a spot rate at 1 pound is equal to 0.8410 divided by 0.8415 US dollar. The bid rate is 0.8410 and the offer rate is 0.8415. In full, the quoting bank is saying that it is willing to buy euros at a rate of 1 euro is equal to 0.8410 US dollar, and to sell euros at the rate of 1 euro equal to 0.8415 US dollar. The price taker performs the opposite side of the transaction to the quoting bank. If the price maker buys euros, then the price taker sells euros, and if the price maker sells euros, then the price taker buys euros. If the price taker wishes to buy euros from the quoting bank, it must buy them at the quoting bank's offer rates, that is the selling rate of 0.8415. If the price taker wishes to sell euros to the price maker, it must sell them at the price maker's bid rate, that is the buying rate of 0.8410. An alternative definition of the bid rate would be the rate at which the price taker could sell the commodity currency. Similarly, an alternative definition of the offer rate would be the rate at which the price taker could buy the commodity currency. Now there is another example in which the bid and offer rates in the foreign exchange market are shown here. The spot rate, which is equal to euro for US dollar, that is the commodity currency, and there is first quote in which 1 euro is equal to 0.8410 US dollar, and the price maker which buys the euros and sells the euros, and there is a price taker who sells the euros or the buys the euros. In the quotation, 1 euro is equal to 0.8410 divided by 0.8415 US dollar. The euro is the commodity currency and the dollar is the terms currency. When a bank buys the commodity currency, it sells the term currencies, and when it sells the commodity currency, it buys the terms currency. The bid rate could also be defined at the rate at which price maker is willing to sell the terms currency, or the rate at which the price taker is able to buy the term currency. The offer rate could also be defined as the rate at which the the price maker is willing to buy the terms currency or the rate at which the price taker is able to sell the terms currency. Now, there is a third example related with terms currency. Bid and offer rates in the foreign exchange market. Spot rate is equal to euro per US dollar, that is a commodity currency, and there are certain bid rates and the offer rates. The bid rate codes are 1 euro is equal to 0.8410 US dollar and the offer rate is 0.8415 US dollar. Then there are certain price maker who sells dollars, then buys dollars, and then are price takers who would be buying and selling the dollars. Bid offer spread and its determinants. Reference rate. Reference rate is the rate issued by the central bank of countries. In India, it is issued by the Reserve Bank of India. Every day, Reserve Bank of India publishes reference rate for spot US dollar in terms of Indian national rupee and the spot euro in terms of Indian national rupee. RBI reference rate is an indicative rate. What is the average national foreign exchange rate prevailing on a given date? This rate is also used by companies to convert their foreign currency, import payments and export receipts to Indian national rupee for financial reporting. The reference rates are arrived at by averaging the mean of the bid offer rates polled from a few select banks around 12 noon every weekday excluding the Saturdays. The contributing banks are selected on basis of their standing, market share in the domestic foreign exchange market and representative character. The Reserve Bank periodically reviews the procedure for selecting the banks and the methodology of polling so as to ensure that the reference rate is a true reflection of the market activity. Relationship between bid and offer or the ask prices of the currencies. One thing which is important to note about the bid and offer rate is that when a particular bank quotes for a currency, it simultaneously offers another currency in lieu. It means if it buys dollars for pounds, it is simultaneously offering pounds for dollars. Hence, there are two sides of all quotes. It simply means that there is an inverse relationship between bid and offer rates. If we know the bid price, its inverse will give us the offer price. In other words, the inverse of ask rate of pounds will be equal to the bid rate of dollar. In general terms, we can write S for bid Y, that is X for bid Y, is equal to 1 upon S multiplied by Y divided by ask X, and S multiplied by X divided by ask Y is equal to 1 upon S into Y divided by bid X, where X and Y are currencies of two countries. It basically states that relationship between bid and offer exists in terms of direct and indirect quotes of a particular foreign exchange rate. Formation of bid and offer rates. For computing bid and offer rates, we need to have the reference rate as the mid rate, which is issued by Reserve Bank of India in India. Let C is an indicator of cost of transaction, R is the reference rate or mid rate. Bid and ask codes are then given as S bid is equal to M multiplied by 1 minus C and S offer is equal to M multiplied by 1 plus C. Hence, spread is equal to S offer minus S bid is equal to M multiplied by 1 plus C minus M multiplied by 1 minus C, which will be equal to 2C. From these equations, it is clear that the spread equals twice the one side average cost of transaction, or it may be termed that one side of cost of transaction equals half the spread. Now, let us look at an example for direct quotation. Suppose RBI reference rate is S, which is equal to 54.75 Indian National Rupee for each dollar. And if one-way exchange margin to be charged by authorized dealer is 0.4%, the direct bid and offer rates would be bid rate is equal to 54.75 minus 0.4% of 54.75, which will be equal to 54.53. The offer rate will be equal to 54.75 plus 0.4% of 54.75, which will be equal to 54.97. So the spread, which is equal to offer minus bid, will be equal to 54.97 minus 54.53 equal to 0.44. Spread or cost of transaction. After understanding the relationship between bid and offer prices of currencies and also the formation of these two rates, now there is need to know the concept of spread or cost of transaction. Spread, as we have noticed, is the offer and bid differential. Spread is also known as the income owed to a dealing bank or cost that occurred by the customer while dealing with the bank. The computation of spread is different in different quotations. In case of direct quotation, spread is computed by the ratio of offer bid offer. In case of indirect quotation, spread is computed by the ratio of bid offer over bid. For example, the bid price of dollar at spot market in terms of Indian National Rupee for US dollar is equal to 55.7621 and the offer price is equal to 55.8024. The cost of transaction would be offer minus bid upon offer multiplied by 100, which will be equal to 55.8024 minus 55.7621 divided by 55.8024 and then multiplied by 100. It will be equal to 0.0722%. If we consider the indirect quotation, offer price will be equal to 1 upon offer price, that is a direct quotation. So it will be equal to 1 upon 55.8024, which will be equal to 0.017920, and the bid price will be equal to 1 divided by bid, that is direct quotation, equal to 1 divided by 55.7621, which will be equal to 0.017933. Now the cost of transaction, which is equal to bid minus offer over bid multiplied by 100, this will be equal to 0.017933 minus 0.017920 divided by 0.017933 and then multiplied by 100, which will be equal to 0.0725%. A few determinants of spread. The main determinants of spread are: firstly, bank versus money changer. The cost of transaction of foreign exchange dealings also depends upon the nature of organization making foreign exchange rate quotations. If a bank is making quote, the spread will be smaller as compared to a money changer or a finance company which has obtained license to deal in foreign exchange transactions. The authorized dealer earns high amount of spread because he deals in very small volume as compared to a bank having a bulk amount of foreign exchange dealings. Therefore, the cost of service per unit of currency traded is lower as compared to the authorized dealer. The second determinant can be fairly versus rarely currency. If the currency is fairly traded, the spread will be smaller than the currency that is rarely traded. Dollar being a universally acceptable currency will have a low amount of spread as compared to Danish krone, which is not fairly traded. Trading volume of the currency. If the volume of the currency traded is small, the authorized dealer tends to quote higher spreads. This is because the cost of transaction required per unit of the currency traded tends to fall in the subsequent period. Currency rate volatility. Irrespective of nature of organization, a high volatile currency will have a large amount of spread possibility to offset the unfavorable impact of currency fluctuation. Perception about economic conditions and forex market. In the near future, if there is possibility that economic conditions would be volatile and hence lead to high risk, the dealer will increase the amount of spread on the foreign exchange dealing. However, a stable economic condition would lead stability in the cost of service, that is the spreads. Now let us summarize what we have learned from this module. To sum up, we can say that quoting bank is the bank that quotes the price. Calling bank is the bank that calls to ask the quoting bank for a price. Quoting bank is also known as price maker, whereas calling bank is termed as price taker. In the money market, the bid rate is the rate at which the quoting bank is willing to borrow. The offer rate is the rate at which the quoting bank is willing to lend. In the foreign exchange market, the bid rate is the rate at which the quoting bank is willing to buy the commodity currency. The offer rate is the rate at which the quoting bank is willing to sell the commodity currency. Bid offer price is always expressed in terms of base currency. Bid offer rates are also from bank's perspective. Bid offer spread determines the profit for the bank. In case of direct quotation, bid price is always lesser than the offer price. In case of indirect quotation, offer price is always less than the bid price. Reference rate is the rate issued by central banks of countries. RBI reference rate is an indicative rate. What is the average foreign exchange rate prevailing on the given date? This rate is also used by companies to convert their foreign currency import payment and export receipt to Indian national rupee for financial reporting. There is an inverse relationship between bid and offer rates. Inverse relationship basically states that relationship between bid and offer exists in terms of direct and indirect quotes of a particular foreign exchange rate. In case of direct quotation, spread is computed by a ratio of offer minus bid upon offer. In case of indirect quotation, spread is computed by a ratio of bid minus offer over bid. In the case of direct quotes, the spread is in terms of domestic currency, whereas it is in terms of foreign currency when the quotes are indirect. Volume of spreads are determined by nature of organization, trading volume of currency, availability of currency, currency rate volatility, and perception about the economic conditions of a country.